Welcome, everyone. Thank you for joining us for today's webinar. My name is Chris Lowe, and I am your host over here at EBS Associates. Most of you are probably familiar with EBS, but if not, we are one of the largest QuickBooks Pro Advisor firms in the nation, and we do everything QuickBooks, everything from software sales, training, cleanup, bookkeeping, and we work with third-party vendors like Mike Milan here. So if you guys have any QuickBooks questions for us, feel free to reach out to me anytime. You should all have my email. I will get you over to the right person here at EBS to get you taken care of. Anyways, today we are presenting lesson 2 of 6 in our 6-part webinar series presented by Mike Milan. Just a little housekeeping before we get started. If you have any questions during the presentation, please type them into the question box in your GoToWebinar panel. I'll bring them up during the webinar, and we will also have time after the webinar for questions at the end. So now, without further ado, I will turn this over to Mike Milan.
Hey, Chris, thank you, man. I tell you, week 2, folks, week 2. Here we go. Last week, if you guys remember, this is all about cash flow, but we're talking about financial management for a small business. That's basically what we're talking about. Last week, I led it off with, you have to be able to build, a successful business owner anyway, builds transferable value. And if you remember, transferable value is how much money do I need to do whatever it is I want to do next. I mean, some people want to sit on the deck, some people want to travel the world, some people want to, just retire and live a good life. Whatever that is, that's what we're working towards, because you don't want to get to the end and figure out that all you did was build a job. You didn't build transferable value. So how do we get there? That's what this whole 6-week series is about, is getting you to the point where you can build transferable value. Now, for those folks that were on the call last week, if you were on the call last week, I left you with some homework. So let me pull up my homework as well. Let me pull that up. And the homework I left you with was really a couple of pages of math questions. And believe it or not, these are important. And one of the key things that we teach in these 9 questions is the difference between gross profit margin and markup. So margin and markup, if you've heard that, that's basically what we're talking about here. And it gets that math muscle working. If you think about adult education, I always think about it as filling your hand with education, filling your hand with knowledge. Now, imagine if we had your hand in a ball like this, and we put a rubber band around all of your fingers. We put a rubber band all around it. The more knowledge we put in there, the more stretches that rubber band. And when we're stretching the rubber band, we got to keep it stretched. And the way we do that is by exercising the knowledge. So don't just attend. Don't make it an hour of your life. Make it something that you're utilizing on a daily or monthly basis. So let's do some math. Kind of kick this thing off. We got about an hour today. So let's kick it off. And I'll go through these with you. I mean, usually when I'm in a classroom setting, I let people bring it back to me, but in this case, we're going to have to, put it in a way that I'm telling you the answer and walking you through how to do it, So, first of all, let's look at question number 1. Question number 1 is, how would 0.234 be expressed as a percentage? And all we're doing is converting decimals to fractions, fractions to decimals, and the way we do that is just move the decimal point 2 places, right? If we're already starting with a fraction, with a decimal, we're going to move that 2 places. So instead of 234, that actually becomes 23.4%. All right, so when you're looking at it and you get your calculator out and you can see these numbers that are happening, it's 23.4%. All right, so if we go the other way with it, it should be just as easy, right? We're at 89.2%. How do I express that as a decimal? Still easy. We're just going to move the decimal 2 places back. So instead of 89.2, that now becomes 0.892. Fairly simple. We're starting off easy. We're getting that math muscle working again. So what about percentages? How do we make percentage into a number? What is 25% of 260? When you see these types of questions, when you see this type of math, just remember this. Here's the rule. If you want to know a number that's larger, you divide. If you want to know a number that's smaller, you multiply. So you've got, if I want to know a number that's larger, equals we're going to divide. If I want to know a number that's smaller, that equals are going to multiply. In this case, we want to know 25% of 260. So because it's only 25% of 260, I want to multiply, right? So we're going to take 260 and then multiply it by 0.25. And getting out my calculator, 260 times 0.25, that gives me 65. So that equals 65. So 65 equals 25%. This is going to become important when I talk about a technique called the mini P&L. All right, the mini P&L, being able to make these conversions and move up and down the value chain, or move, do I want a number that's larger or smaller? That's going to help you determine whether you multiply or divide. Okay, what about the percentage equivalent of 3/8? All right, so if you see a fraction, you want to convert that to a percentage, you just take the fraction and divide it. So 3 divided by 8 equals 37.5, right? So the percentage equivalent, so 3 divided by 8 actually equals 0.375. And because of what we learned up here, we take 3.75 and turn that into 37.5. Okay, so that would be the equivalent, 37.5%. Gets a little bit more tricky now. Now we're going to start taking these and converting them into real life word problems, things that are happening in your business. In answer number 5, or question number 5, McKee Hardware forecasts their sales will increase from 250 to 460. From 250 to 460. What's the percentage increase? Some people get this wrong. All right, and there's a formula that you use, and the formula is pretty simple. It's new minus old divided by old. So the new number minus the old number divided by the old number actually equals the percent increase. If it's negative, that's going to be a percent decrease. All right, so that's the formula, new minus old divided by old. In this case, we went from 250, that would be the old number, to 460, that's the new number. So we have 460 minus 250 divided by 250. If we look at that, 460 minus 250 equals 210. So we got 210 divided by 250 equals 0.84. So 0.84, if we move the decimal, it's 84%. So the percent increase, when we went from 250 to 460, we increased our sales by 84%. That's kind of how we're getting there. So new minus old divided by old. Continuing along those lines, what's the percent decrease? Understanding that it's new minus old divided by old, same formula. New minus old divided by old. That equals, we're going from 500, that's the old one, to 328. So is the new one. So we got 328 minus 500 divided by 500. Taking those out, so we got 328 minus 500 equals 172 divided by 500. 72 divided by 500 equals 0.344, 0.344, or 34.4%. All right, so that's a percent decrease of 34%. So when we go from 328 to 500, we're decreasing sales by 34.4%. Okay, let's talk about the difference between margin and markup now. We're a retailer, we're going to buy a shirt, right? We're going to take inventory, put it on the shelf. We buy it for 26, we want to sell it for 40. What's the gross profit margin percentage? Now, an easy way to do that is 40 minus 26. We sold it for 40 minus 26 divided by sales. All right, so it's the sales minus cost of goods sold is really gross profit divided by sales gives you the gross profit margin percentage. Now, let me show you a way to do this very easily if you don't want to do the math. If you've ever done a Sudoku puzzle, I'm going to teach you a technique called the mini P&L. All right, here's the mini P&L. This one over here. It's taking the main components of an income statement And when I say it's a Sudoku puzzle, there's only one thing that fits, right? One number will fit in every single situation. There's only one number. Don't pay attention to this just yet. But it's sales minus cost of goods sold equals gross profit. Then we subtract out our operating expense equals net operating profit. That's the main components. What we do is we fill in the blank. We take the word problem or what's happening in our businesses every day, and we fill in the blanks. When we talk percentages, right, gross profit margin percentage, we talk about it as a percentage of sales. So that means sales is always 100%. In our word problem, we bought something for 26, we sold it for 40. So if I fill in the blanks right here, I bought something for 26, so I've got dollars in sales, or percent. We got 26, and we sold it for 40. 26, and we sold it for 40. 40 minus 26 equals 14. So, how do we determine the answer that we want is the gross profit margin percentage? What should go in that box? Well, 14 is the percentage of sales. 14 is a percentage of 40. So if I take 14 and divide it, because I want to know a number that's larger, I divide it by 40, equals 35%. 35. 14 divided by 40 equals 35%. 14 divided by 40 equals 35%. If that's the case, there's only one number that can fit here. That way we already know that our cost of goods sold percentage is 65. 100 minus 65 equals 35. That's kind of how we get there. So the answer to the first question, what is the gross profit margin percentage? 40 minus 26 equals 14 divided by 40 equals 35%. Now some people, when they say what's the percentage markup on cost, will tell you that when the difference between 26 and 40 is 14, and they get confused. This is the difference between markup and margin, right? Markup is on cost, margin is on the profit, right? The difference between cost and profit. So the difference here, we bought it for 26, we sold it for 40. That means we marked it up $14. Don't get confused. It's not 35%. Instead of 14 divided by 40, it's now 14 divided by 26. That's the markup. It's divided by cost. It's a markup on cost. So 14 divided by 26 equals 53.8. We'll just round it up to 54%. 54%. So 40 minus 26 equals 14. 14 divided by 26 equals 54%. So how much were things marked up? They were marked up 54%. I see even larger retail stores get this wrong. When I try to do the math between what's on their tag and what they say on the sign, oh, this is marked down 90% or marked down 75%. Well, when I do the math, it isn't that way. So it's one way to quickly check it on how much it is, or how much they've marked it down from retail. It's markup on cost or marked down from retail. Sometimes they just say markup and people think markup from cost. So that's how you do that. Now, what's funny about the next one, by taking 20% of a number, you get 2004. What's the number? I don't know why this is, but there's a lot of kids out there that take the SAT or the ACT and they miss this question, right? That's one of the reasons I throw it in there is because some people are just like, what's 20% of a number, if I get 2004? What this is saying, when you see things like this, or you run across it, is I have 2004, and that's 20% of another number. 20% of another number. That means the 2004 is only 20% of a larger number. So because we want a larger number, we divide. 2004 divided by the 20%. The larger number is 2004 divided by 0.2 equals 10,020. 10,020. Okay. 10,020 is what it is. Now, remember, we're just going over, my hope is that during the break, you guys did this little exercise and we're just checking our work, but if not, you can follow along. The last question on this is the most important in my mind. It's the absolute most important. The reason why it's the most important is because I've had business owners leave my class, right, on the first day and reprice their entire store because they've mispriced it. This is how you price your products. This is how you make sure you're making enough money to be able to handle your operating costs, to be able to make some net profit at the end. If you get this wrong, you'll lose money, and I'll show you how. First of all, we're going to buy an item for $54, and I want to make 25% gross profit. How do I know I want to make 25%? Right? Some people go, I don't know if I want to make 25% or not. Here's the reason you know, or how you know. That's what you've typically been making in your business is running the way you want it to. When I take sales minus cost of goods sold, I get 25% left over, right? So a quarter on every dollar in new sales I get to spend on operating expenses. If you don't know where to start, it's okay. Look at the industry average, right? So you use the Finagraph dashboard, ask your bank, look it up on the internet. What do other people in my industry make as a gross profit? This is the most important numbers because you can only spend gross profit. You can't spend sales. You can only spend gross profit. So think about that. That's the only dollars you got to spend, so it's the most important number in the income statement. So you got 25% equal of your gross profit. If you don't know where to start, look at the industry average and start there. Again, if you're watching this seminar, you're not going to be average next. So minimum bar is industry average. You should be shooting for something more than that. Okay, so if you buy an item for $54 and want to make 25% gross profit, what should you sell it at? What you should price it at? If you've done this, all right, if you did your homework before you got here, the most common wrong answer that you can get is $67.5. If you get $67.50, that's the wrong answer. All right, and the way some people get there is they'll take 54 times 0.25. That equals 13.5 plus 54, 67.5, right? They just take 25% of 54. That's not what gross profit margin is, all right? It's not 67.50. It's actually, the answer is not 67.50. It's actually $72, all right? Let me show you how to get there. Going back to our mini P&L. We're going to use the Sudoku Puzzle, right? We're just going to fill in the blanks. We bought an item for $54. We want 25% gross profit. So, cost of goods sold was $54. Gross profit percentage was 25. That means 54 is what? 100 minus a number equals 25. Yeah, 75, right? So, we got 75% here. That means that 54 is 75% of sales. So I take 54, and then because we want to know a number that's larger, divide that by 0.75. When I do that, 54 divided by 0.75 equals 72. 72 minus 54 equals 18. Is 18, this is how you check it, is 18 25% of sales, 72. 18 divided by 0.25 equals 72. Everything checks out. If you get this wrong, the numbers won't check out. Here's why it's important. Let's pretend we're in a company where it takes us $15,000 a month to keep it open, right? To pay the rent, to pay our employees, to pay gas, whatever we're doing inside the building itself. Just to stay open, it costs us $15,000 a month. 18 minus 15 equals 3. It's a good month. I've seen people do their pro formas. They get out there and do their budgets and say, this is how we're going to run the business, and if I hit this sales number, I'm also going to make this much money. Well, let's go back to the most common wrong answer in the world. If we do this wrong, and we price our goods at $67.50 because of the way I just showed you some people do it incorrectly. $67.50 minus 54 equals 13.5. 13.5 minus 15 equals negative 1.5. Negative 1.5. Yeah, that's how it happens. And you don't find out till too late. You have a plan on your Excel spreadsheet of what you're going to make, and then you get out the pricing gun and you put stickers on it because you said, oh, 25% is 67.5. Boom, 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 boom. You price your whole store. At the end of the month, you go, oh my God, how to lose money? Well, let's go back and check our work. If we're doing this correctly, and we want 25% gross margin, is 1350 25% of 6750? That's how we check our work. It's 1350, 25% of 6750. So I divide that. 1350 divided by 6750. When we do the math, it's 1350 divided by 6750. No, it's 20%. So that's how it happens. You left 5% off the table. The numbers won't work if you do this wrong. That's one of the ways that we can figure it out. The numbers won't work. Now, that's the check indicator. We want it to be 25. It's not. It's 20. So, again, the most common wrong answer in the world is 6750, and you do that if you take 54 and divide it by 0.25. We'll get it wrong. Okay, that's your math homework. Hopefully everybody got it right. Hopefully we're in a position where we can start to talk about moving forward and how we do some of the ratio analysis, how we start looking at how cash comes through our company, and how we can improve our businesses. So let's move on. How do we know what to do to price our goods properly? Remember, you don't want to be in that position where it's 67.5 when it's supposed to be 72. So here's what you do. You determine what your multiplier is, which means it doesn't matter what you buy a good for. It doesn't matter. You're going to take that number and multiply it by something to always get the right price. Well, what's the multiplier? Most of us don't know. So you're going to do an example using 1 as the cost. So in this case, we buy a good for $1. And we want to get 27% gross profit. How do we know that? Because the industry average is 27%. And if the industry gets it, I should get it too. So if the industry average is 27, that means that $1 is 73% of sales, right? It costs $1, it's 73%, and it's 73% of sales. So when I take that, I divide 1 divided by 0.73, that actually equals 1.37. Some people will go, oh, it's 27%, and they'll only add 27 cents on the dollar and say, oh, I charge $1.27. Don't do that, right? Go through this step and determine how much it actually is that you have to charge. So 137 minus 1 equals 37 cents. Is 37 27% of $1.37? So we take 0.37, 0.37, and divide that by 1.37, and the answer is 27%. Some people will say, oh, that should have been 27 cents, and I would have charged $1.27 on the dollar. If you do that, 0.27 divided by 1.27 equals 22%, or I'm sorry, 21.3%, not 27. It's a Sudoku puzzle. That's how you can check yourself. So 137 is what we would charge to get 27%. Now, here's what you can do. This number is your multiplier, right? That's your multiplier. That's what you're going to use to multiply anything. If I buy something for 54, if I buy it for 178, I'm going to take that 178 times 1.37, 178 times 1.37, and I will charge $243.86. $243.86. And if I did this right, $243.86 is the sales, and $178 is the cost of goods sold. So doing it on this side, 243.86 minus 178 equals, minus 178 equals $65.86. That should be 27%. 65.86 divided by, right? To do that, we're going to divide it by 243, the sales number, like we've been doing. This is about the third time. So we're going to divide it by 243.86, and it is 27%. Okay, that's how you get there. You take 1 as a cost, whatever you want your cost of goods sold or gross margin percentage to be, and however it takes to get there. 1 is 73%. If you want to know the multiplier, you do 1 divided by cost of goods sold. This is exactly what we do, times 0.73. 1 divided by cost of goods sold, which is 1.73. So 1 divided by 0.73 equals 1.37. Now, if you want to do the markup, you just do it the other way. You do it price minus cost, right? Instead of the actual sales price, you want to do the cost. So that's how you get there. That's you don't need to know that for now, but I'm just showing you how to get to a markup if you're interested in it. Now, the good news. The good news is this. On the charts, right, on the charts below, I've already did all the math. All you got to do is find out what you want. If you're in a business where you want 44% gross profit, you just multiply it by 178. I'll do you one better. Anybody that emails me, Mike@Finagraph.com. Mike@Finagraph.com. I've already built this into an Excel spreadsheet. You just type in what you want as the gross profit and how much you paid for it, and it spits out the cost. You'll never get pricing wrong again. Never get it wrong again. So if you want an Excel spreadsheet for free, just email me at Mike@Finagraph. If you're not interested in that, you can do it by hand. Either way, I've got you surrounded. You've got knowledge now, and I got you surrounded on how to do these things. Okay, so let's talk about how much should you sell. How much should you sell? We'll do a little break-even analysis. If you remember on bar napkins, that's really just a blank piece of paper. In episode 1, I told you about the tools that I use, and what this is called is the mini P&L. Sales, cost of goods sold, operating expense. That's the mini P&L. Let's pretend I've got it down here. Find break-even. How much should I sell just to stay open? Some people don't know this or how to find it. We're going to pretend that operating expenses, you need to know 2 things. How much it costs you to stay open, and how much gross profit margin percentage that you need. How much do you pay, and how much money do you have? So let's fill it in. Operating expense is 210, and I want 35%. So I'm on the percent side, and I'm on the dollar side. I want 35%. If that's 35%, then this has to be 65%. 100 minus 65 equals 35. So the 2 numbers I need to know in order to find my break even is the gross profit margin percentage, how much do I want, and I get that through the industry average, and how much am I currently paying to stay open. When we talk about break even, that's when gross profit and operating expenses are equal. So we want net profit to be 0. I didn't make money, I didn't lose money. That's breaking even, right? This is an important distinction on how to get there. So you want to break even. We have to work this backwards now. If this is true, I want 35% and it cost me 210, what does this have to be? What number minus 210 equals 0? Go ahead and use your calculator. I'm just kidding. No, it's 210, right? 210 minus 210 equals 0. That tells us that 210 is 35% of sales. How much do I have to sell to break even? And this is important for building out. You don't want to build a budget that loses money. So this is one of the ways you get there. 35%, 210 is 35%. Because I want to know a number that's larger, I divide 210 divided by 0.35 equals 600. So 600 minus whatever the 65% is equals 210. In this case, it's 390. 210 minus 390 equals, 600 minus 390 equals 210. Subtract that to 210 for the operating expense gives us 0. That's our break-even point. Here's a rule about break-even some people don't know. Here's a rule. At break-even, when you achieve this point, every new dollar in sales, net profit will increase at the gross profit percentage. I'm going to write that down. All right, so at break even, net profit increases at the gross profit percentage. That means for every new dollar that comes in, 35 cents in this case goes to the bottom line. So we can work that out. So 35% goes to the bottom line. Once we have all of our expenses covered, 35 cents on the dollar goes down to the profit. That's important to know because we need that profit to determine if we can meet our transferable value number. Let's put that into action. I'm going to add $1, 601. This won't be here. 601, and this won't be here. We know that this is 65%. So cost to get sold is 65% of 601. So we'll take 601 times 0.65. Because we want to know the number that's smaller equals multiply. That's 390.65. 390.65. So let's think about that. 601 minus 390.65. That equals 210.35. 210.35 minus 210 equals 35 cents. There's the proof. Every new dollar that comes in after break even increases net profit at the gross profit percentage. Here's why that's important. Let's say you want to hire a new person, right? I'll go back to here. We want to hire a new person, and that new person cost us $4,000 a month. That's what it costs. We already have $210,000, but now we want to increase our operating expense by 4. We still want to get to break even. Some people would say, oh, instead of $600,000, I now have to sell $604,000. No, you don't. You only have 35 cents on the dollar to pay for that. So using the Sudoku puzzle, the mini P&L, how much do I have to sell now? Remember the last one, at 210, we had to sell 600. Now at 214, we want break even to be 214. And 214 is 35% of another number. That equals 611.43. So $11.43 equals the equivalent of, in this company, $214,000, or actually $4,000 in increased expense. This is how you know what you should charge, or what a salesman's quota should be. Right? If I add $4,000 in expense, you should at least cover your own salary, right? So I give you $4,000, you need to bring in $11,043, right? $11,430 in order to cover you, right? That's his quota. We don't want him to break even though. We want him to at least give us how much we want left over. How do I know how much I want left over? Back to last week. When I said, take your transferable value, it's the number, right, that it takes for you to live for 1 year, multiplied by 25. That's how much we need to get. If it comes up that you need $10,000 a month to get there, let's try that. Now we're adding net profit into the mix. We'll move everything back to the original. Now I want 10,000 left over, not 0. So if that's the case, instead of 210, it's a number minus 210 equals 10. That would be 220. Now 220 is 35% of sales. 220 times 0.35. Now I have to sell, 220 times 0.35. Oh, divided by 210 divided by 0.35 equals 600. But 220 divided by 0.35 equals 628.57. 628.57. So in order for me to start hitting my transferable value number, now I know I want 10,000 left over, in order to have 10,000 to put in my savings or put it back into the company, I need to sell 625 or 28,057 cents. So that's how you get there. That's using break even to set your transferable value, to know if you're going to increase cost, how much more do you have to sell, but you use two numbers that you need, this one and this one. They're the most important to determine how much you need to sell, how much you want to have left over, how much are you spending. So let's move on. We're moving pretty good. That was a lot of math thrown at you. Take a break, take a drink, tell your partner they did a good job, and let's move on. I'm going to spend the rest of the time talking about personalities. And you're like, well, wait a second. This is a math class. This is about cash flow. It's about understanding how to manage my business and finance my business. In order for you to understand, right? Understand how people react, how you can sell more, how you can interact with people better, you've got to understand personality types. And if you go to your success principles, that other page we started building, successful business owners, SBO, know that they have to be chameleons, right? So when you're dealing with other people, and this is going to be important because when I teach you the ratio analysis and teach you about cash flow, I'm going to use a case, a guy that I actually worked with in Missouri, and you'll see his personality and the way he makes decisions. So the personality is one of the things I put in there because you have to be able to determine who you're dealing with. So let's talk about that for a second. This is the DISC method, right? It's really just driver, expressive, amiable, analytic. It's just all of us kind of fall into one of these at every given point in time. And you're not always a driver, all right? You can be an amiable at certain points in time. You can be expressive at certain points in time. But at various times we fall. We might lean towards one place or the other, but at various points in time we're always, at one of these more dominant. Okay, let me explain what they are, all right? Because people make decisions in what's called their limbic brain. That's the part of the brain that doesn't control language or rational thought or logic. It's feelings, right? You make a decision with your feelings, and that's why we say things like, yeah, I know what you're saying with your facts and figures. It just doesn't make sense, right? It doesn't, I don't know why. I have a gut feeling, or I believe it with my heart. You'll say these type of things and not know why. It's because the part of the brain that controls decision-making doesn't have a capacity for language, so you can't describe. I ask people all the time, why do you like your best friend? A lot of people go, oh, I don't know. Yeah, I just found one human I like. Well, no, I mean, there's something that talks to each other, right? It's people like people that believe the same things, and they can get a feeling. I'm going to boil it down more simply. We like people who communicate with us the way we like to be communicated with. So that's why I added this in, is that we got drivers, expressives, amiable, and analytics. And if you know how to deal with those folks, you can be more successful with everybody in your life. Okay, so a driver. Let's start there. Starting with a driver, those are the guys that say, hey, I need this, that, and the other done. I need you to pick up your stuff right here and move to that other desk. Go, right? These folks are not afraid of controversy. They're not afraid of confrontation. They're results-oriented. They drive tasks. They drive results. And they're a little aggressive, right? But they hate to have their time wasted. Those of you that know me know that my first job, I was a state trooper. Generally, when I went to work, guess what? I was a driver, right? I mean, I knew 3 steps. That's all they taught me was 3 steps. It was ask politely, tell nicely, and then make people do it. So there wasn't a lot of negotiation, with a state trooper. It's just ask, tell, make. But here's how you deal with a driver personality, right? It's called the 3 Bs. 3 Bs. 3 Bs. And that's be bright, be bold, and be gone. So you want to be smart with what you're telling them. You don't want to, be bold, which means you can't be timid if they'll run you over, and then be gone, which means don't waste your time. So say what you're going to say it up front. Matter of fact, I'll give you another acronym for dealing with these folks, and it's BLUF. BLUF, bluff, right? And not bluff like you're lying to people. I don't think that's 2 Fs, but bluff like bottom line up front. Bottom line up front. And I'll give you an example from my trooper days. There was, right, when I was a trooper, people that came, I would walk up to the scene of an accident, and I would get every story in the world besides what happened in the accident. Right? I would get, oh my God, it was the worst. It was the worst day ever. Right? I mean, we started off bad. I mean, I had dropped the coffee carafe, spilled coffee all over the kitchen counter. The kids were crying over it because of the loud noise. The dog was barking. My wife got mad at me. It was just terrible, right? So after I got everything cleaned up and kind of got it, got everything going, I was on my drive, and my song came on, and you don't know the song, but I know it, and it was the first song that we had, and I felt really bad, so I reached down to grab the phone to call my wife and tell her that I was sorry about this morning, and boom, I got into an accident. I would get there, see the evidence that's at the scene, how the cars are positioned, and I'd say, sir, you ran a stop sign, right? So it's one of those things where he told me all the fluff, everything around the accident, when in reality he ran a stop sign and hit another car. My daughter does the same thing to me all the time. She says, hey, Ashley and her boyfriend broke up. We need to go to the mall. She needs some girlfriend time. We're going to just, kind of talk it out and walk around the mall and all that. Can I have $50? So I'm like, no, lead with the can I have $50? I don't need the whole story about Ashley and her boyfriend and how they broke up. If you wanted to come to me for money, ask me for the money. So that's the difference. Bottom line up front. Tell me what you want first or what happened first, and then if we need the details, we can fill that in. That's how you mess with a driver or deal with a driver. Second one is an expressive. The expressive personality is that got that cheerleader. Oh my God, we're on a project together. We're working together. All this is fantastic. I can't believe this is awesome. I mean, this is going to be the best project ever. And they get everybody rallied up. It's the person at the party that actually you kind of gravitate towards, like, oh man, he's telling a great story, and he is telling a great story, and you go over there and you just kind of listen, you get involved, and you feel emotionally connected to the guy somehow, But here's what I can tell you about an expressive personality: you can only believe about 50% of what comes off their lips, right? and not because they're liars. That's not what I'm saying. It's because they're so excited about the project that once it becomes real work, once you actually got the details and you're starting to execute, they lose their attention, they lose their focus, right? And so you have to keep them on task. Think about it like this: if you've seen the movie Up, the cartoon for kids, there's a dog with a voice box, and every time he sees a squirrel, he goes squirrel and takes off. That's the expressive personality. The next shiny bright object is where he's going to go, right? So what we want to do is deal with an expressive personality by helping them stay on task, helping them stay on focus so we can get the project done. Then you got the amiables. And some of us are amiables at any given time. And what an amiable is a person that kind of nervous. They come in, they sit at the back of the classroom, or they go to the networking event or a party, and they just kind of sit there and they kind of listen. They don't do a lot of interaction. They kind of hide, not hide, but they stay off by themselves. Or they'll sit into a seminar that I teach, and they go, oh, man, I hope he doesn't call me. He's looking at me. I don't want him to talk to me. It's okay to be amiable sometimes. Here's what I can tell you about an amiable personality, is that it takes a long time to build their trust, right? It takes a long time. But once you have it for life. And not only that, you start to see their other dominant personalities. They're amiable in a social situation, but they become more loyal and more maybe analytic or expressive or a driver as they get to open up to you. It just takes a while to get there. But once you got it, you got them for a long time. And then the last one is the analytic. The analytic is, it's the person that has nice, neat little boxes and rows. They like everything kind of stacked up, and they can see everything that's happening. They can understand the process. They can see how it goes from A to B to C to D. Here's what they can't do, right? If C's missing, they go A, B, D. They get in trouble when they can't see every step, and they have to fill in the blank, right? You've heard him say it, right? An analytic will say this, and you'll know, oh my gosh, he's an analytic personality. He'll say, yeah, I'm just not going to be able to make a decision today because there's just not enough information. I just don't have enough information to make that decision. That's somebody that doesn't see the connection when it's not spelled out for them. So to be successful with an analytic personality, you've got to show them A, B, C, at least give them an impression of what C should be, and then D. So walk them through. Don't leave a blank space, or you'll get them into a paralysis situation. So those are the four personalities, as they exist. So let me tell you something about the personalities now. And what's strange is there's a thing called left brain and right brain, right? You've heard of all that, left brain, right brain. Well, it's based kind of loosely on this type of disc method, right? Who's the left brain, who's the right brain? Here's something interesting about this. 80% of small business owners are on this side. Our drivers are expressive. They're the ones that are creative. They're innovators. They just want stuff to get done. That's how they are. They're 80% of them are the creative, more driven, more passionate people. 80% of accountants and bankers are on this side. They're more analytic or amiable. They like to dive into the numbers. They like everything, about process, and they're more introverted, right? Matter of fact, how do you know if an accountant's having a good day or a bad day? Yeah, well, he wears his light gray socks on good days. And I'm kidding, of course. I love accountants. It's just a funny joke to me. But that makes for an interesting conversation. The reason I say that is because I started off this segment by saying a successful business owner should be a chameleon, right? So when you're dealing with folks, let me give you an example of a conversation that I heard. It's a business owner, and I'll just say it's me. A business owner walks into a bank and says, "Hey, I've done this like 18 times. I've been working with you guys for 30 years. I need $50,000 from the next idea." And then the banker looks at me and goes, "Mike, I'm going to need 3 years tax returns, income statements, balance sheets, all that type of stuff." I said, "Oh, wait a second. Hey, don't be getting wrapped up in the paperwork and all that type of stuff. I need $50,000. You've seen me do it. I've done it before. I can do it again." "Yeah, Mike, I need 50,000. Or I'm going to need bank balance sheets, income statements, tax returns." Yeah. What they're doing is they're bringing me down. I'm up here with my excitement, my enthusiasm, all that type of stuff, and then bring me down with process. In order to be successful in that conversation, I should go, "Mr. Banker, I need $50,000 to get this project off the ground." And then that banker should say, "Mike, I know you can do this. No problem. I need 3 years tax returns, balance sheets, income statements, all that." I'm just saying, when you match the personality, it's a lot better conversation, right? And people like to do business with people that they trust, people that they believe in. And one of the ways we can do that is by matching the personality style of the person that we're talking to. All right, so talk to people in the way they like to be talked to. Now, what's interesting here is if you draw a circle in the middle, put an X where you think you are. Are you more driver? Are you more expressive, amiable? All of us are kind of any one of these, but where do you think you are? And this is why it's important. This is kind of your self-diagnosis. Now, there's a website out there. It's a free personality test based on this one. And this guy doesn't know I do this, right? So he's probably the most confused website owner in the world because I tell people about his free personality test. He's a retail doctor. If you go on Google, I don't even forget the website's name, but if you go on Google and go retail doctor personality test, it's about 50 statements. It takes like 4 minutes to do, and you go, "This is me, this is me, this is me, this is me," 4 minutes. It will tell you which one of these you are based on just answering 50 like checkbox questions. Is it you or not you? If it's not you, you don't have to do anything. If it's you just check. And it will give you a nice narrative. You're 33% driver, you're 27% this, you're 14% that. But it will describe your personality. It's interesting to always see what you did during this exercise, and then you go take the test and see how well it matches up. That's kind of how well do I know myself. Now, I say he's the most confused website owner in the world because I don't know the guy, never met him. He doesn't know anything about me, but I'm in Miami, Chicago, New York. Now I'm doing this webinar on the internet. There's probably people every time I go to a new city and tell him about this, he has a spike in traffic. He goes, "Man, I'm killing it in Miami today. What'd I do?" Or, "I'm killing it in Portland." Right? So he doesn't know where the traffic is coming from. So it's kind of funny to me. I chuckle because I'm in software business. So just something for you to do is called Retail Doctor Personality Test. You can figure out what you really are. And some people, maybe they're multiple personalities. Maybe they don't have personality at all. I don't know. But you'll figure yourself out. Okay. Let me set up this, right? So I'm going to spend a little bit of time here. You've seen this. People have a personality, but so does your business. And it's important to know because you can do different things at different stages of your business. You can't do, all of it at the same time. You have to wait for the right stage to do things, right? And you've seen it. Some people call it startup, growth, maturity, and then what's that? Decline. Because I can't even remember that, I named them Wonder, Blunder, Thunder, and Under. Those are the 4 stages for me: Wonder stage, the Blunder stage, the Thunder stage, the Under stage. Here's why they're important. I mean, the Wonder stage, that's the people that leave corporate America and they go out and they start their own business, and they just got a great idea, right? And we all know that about 8 out of 10 of these fail. They just fail, and they fail for various things, various reasons. They don't have enough money. They're not the right person. They can write a great program, but they can't sell it, or they don't know accounting. They can't. Maybe they have a great idea, but it's only a great idea for their circle of friends, and as soon as they introduce it to the market, nobody likes it, right? That's kind of what happened to TiVo. TiVo was, something that could have been a commercial success. It never made money. It was a great idea, but as soon as they showed it to the market wasn't ready for it. They were kind of ahead of their time. By the time the public was ready, well, everyone else already had a TiVo-style DVR in their product, such as the cable companies. People already had that. TiVo didn't have a cable company. They couldn't produce the channels, but they could record it. Well, cable companies started recording it, and it was kind of all done for TiVo. Here's how these people get money, the 3 F's, right? You're not going to go to a bank a lot of times or to a venture capitalist or a private equity firm and get money. You're going to get it from friends, family, and fools. So that's kind of where they get money. But occasionally, 2 out of 10 of those make it. Right? 2 out of 10 make it. And you make it because you can feel, all the way through here, I'm pushing. Here's my product, here's my service. And then all of a sudden, it starts to flip, right? Where the market starts to pull. I want that product. I want that service. You feel it when you're in business, the push versus the pull. I'm pushing it out to the public, or they're pulling it from me. And you want to get to that pull phase, all right? This is the most important phase in the life cycle of a business, and that's why I call it the blunder phase. And there's 2 main things that kill companies in this phase, right? One of them is called you can grow broke. Grow broke. And most people go, what do you mean you can grow broke? Yeah, you can actually outrun your money, right? You can grow so fast that you outrun it. It's everybody's dream to get the Costco contract, but once they get it, they have to fill the orders, right? And here's the thing about Costco. If they order 100,000 units and you deliver it and they sell it in 1 day, you don't get paid in 1 day. You get paid in 90 or 120 days. Whereas the second day, they're going to order 300,000, maybe 500,000. They're going to keep ordering and still pay you on the same timeline. You have to be able to fund the inventory. You've got to be able to do that. So you could have all of your cash wrapped up in your inventory, waiting for receivables, waiting for money to come in. This is getting back to the cash flow stuff, and we're going to be managing the speed of cash, the cash conversion cycle. But this is where one of the most important things that happens to a company to make them grow broke. It happened to a guy, right? A guy that is pretty close, former military guy, and he built a fitness product. So he built a fitness product, and basically what happened in his world is that he believed in resistance and aerobic activity is the key. And he built a product called the Body Rev. And if you go look it on YouTube, it's the Body Rev. It was a weird kind of contraction that looked weird when you used it. It was awkward to even show you to pretend to use. But nobody bought it, right? He was on Home Shopping Network and QVC, and he was out in the public and spent a ton of money trying to push that out. Near the point in time when he was at the end, when he was near the end of his money, he pivoted the company. He took a change. He just moved the company slightly, and he took the components of the Body Rev and created a product based on the military push-up. And it just turned your hands like this, just turned your hands. It's called the perfect push-up. Yeah, right, that guy. So when he built the perfect push-up, it went everywhere. I mean, everybody bought a perfect push-up. I've got a perfect push-up. I mean, I hide mine in the closet, but everybody bought it. Target had it, Walmart, as seen on TV, didn't matter. And then he grew. He had $2 million in sales the first year. He had $60 million in sales the second year and almost lost the company and had to go out and get equity financing. And he since sold the company after he made the perfect push-up and the perfect sit-up and the perfect martini and everything else, right? This guy's just perfect. But his whole idea was to create fitness products that people want. He almost lost the company because as the orders were coming in, he was having to fill them. That's the growing broke side. So when you get those contracts, make sure you take them on in a portion where you have enough working capital, enough access to cash that you can fill it. You can do that through debt or you can do that through equity, but the cash has to keep the business going. All right, that's one of the ways to do that. The second one is one that I violated. It's called a Sideshow Venture. All right, that's number 2. Sideshow Venture. And what that is that if you're good at something, people see it, right? They start to see, oh my God, he's a great business owner. He's got the Midas touch. And when people see that you're good at something, they want to do business with you, right? So if I'm in my case, I had a hotel staffing company, 3 restaurants, and some multifamily housing units all operating at once because it was just people. I could just teach people as a service-based business, and then I had the apartments for not only my employees, but also it was just rents. So all of them kind of worked together. It was a perfect time to get into the herbal supplement business, right? No, that doesn't fit, right? Everything else is people, and then I place a retail product. Bottom line is, when I took on the retail product, it diverted my attention to the retail side, so my other businesses started to decline. I wasn't paying attention to them as much. And because I didn't know as much about retail, I failed. Not only failed miserably. I lost, about $150,000 just on the retail product. So if you ever want to talk about it, give me a holler, and I'll tell you about, what the herbal supplement business was like for me. But Sideshow Ventures, this is saying stick to your knitting. If you're good at one thing, don't let other people, who want to partner with you, put you in a situation where it's too far outside of what you're already doing, right? Kind of stick in your niche, things that you're good at, add businesses that are complementary or supplementary to what you're already doing, not so far different that it takes a whole different mindset to run. And I did that. Last 2 is pretty easy. If you're going to do something, in the thunder or under stage, thunder is when you kind of made it. This is where you got a war chest. When we're talking about how much cash should I have, right? Here you're going to look for 3 to 6 months operating expense. That's kind of the goal. So if it's $10,000 a month to run your business, try to have $30,000 to $60,000 a month, or not a month, $30,000 to $60,000 set aside. A good rule of thumb is 45 days, but I always tell people focus on 3 to 6 months operating expenses cash. Thunder companies will do 18 to 24 months of operating expense. And that's, some people call it a war chest, some people call it an abundance chest, but that money helps you survive threats, such as a hurricane that happened in Miami or Houston, or take advantage of opportunities like a competitor's on the ropes and maybe you can buy them out. 18 to 24 months operating expense is more of a war chest, but anywhere between these 2 is kind of where you want to focus, 3 to 24 months. Anything over 24 months, a lot of times, you're maybe underutilizing your capital and you need to invest in equipment, grow your sales, open another location, buy a company. But that's kind of the things that you can start doing for how much cash should you have. Then lastly is the first watch it. Right? If you've looked at it, the first watch it is watch out for Founderitis. It's the guy that goes in and does the same job over and over and over again, and as he does, he kind of takes his foot off the gas. And when you take the foot off the gas, so do your employees, and the company starts to dip. When it starts to dip, it takes a lot of work to regrow again because it almost takes a change in leadership. It almost takes a change in energy. Once you take your foot off the gas, it's hard to get people back. So that's the understage, and I call it Founderitis. That's when somebody's just kind of, done with it. They've done the same job for 30 years. So this is kind of setting us up for next week. Next week, we're going to talk about financial position. This is when we finally start to talk about, here's the company's income statement, here's their balance sheet, what do they look like from a health perspective. If you want to read ahead, look at Section 2, and we're going to talk about specifically Spectrum Manufacturing. So read the case, look through, kind of gather, some information about the income statement, the balance sheet, and we'll talk about what types of questions will we ask this company. I'm not going to give you an insight of how I do it. I want you to just kind of think about it from your perspective. What would I ask this guy? The situation is he needs a line of credit, and we're going to see if there's enough cash in the company to give him a line of credit. By the end of next week, you'll be able to, learn how to start analyzing the company. So, hey, Chris, I'm going to turn it back to you, buddy. That's week number 2 in the books. And if you don't mind, I'm going to bid you adieu.
All right. Well, thank you, Mike. I appreciate it. You are actually the only person who has ever been able to capture my expressive brain's side long enough to do a math problem. So I appreciate that very much. I actually learned a lot there.
Oh, good. Thank you.
Thank you all for attending. I will send a follow-up email with all of the personality test and slides from lesson 2. And next week, Wednesday, is going to be lesson 3, same time, 1 p.m., and I will send that out in the email as well. But thank you all for attending, and thank you very much, Mike. That was great as always.
All right. Hey, we'll see you next week, and let's do it again.
Sounds good. Bye.
All right. Bye-bye.